Welcome to the PJ Finance Show. My name is Manuel, and this presentation reflects my main takeaway from Week 3 of Professor Chia's Financial Markets and Responsibility course. Today, we will be talking about raising capital, and go over capital regulations, types of capital firms, and different stages of investment capital. To start, let us raise the question. Why is raising capital so important in the first place? Well, for any entrepreneur or business owner, think of capital as the fuel that runs your business. Every business needs money to grow, expand, and be competitive in the open market. At the end of the day, anyone can generate a great idea. Every great company in the game was once just an idea. Think of Microsoft, Tesla, Apple. Without capital, these companies would have never existed, and would have simply stayed as ideas. With capital, your business will be able to reach its full potential. Understanding regulations is very crucial when it comes to raising capital, to ensure the business owner and investors' protection. In 1993, the Securities Act was issued in order to provide protection for investors against securities fraud. This act regulates the sale of securities by requiring business owners to register the sale of securities with the SEC, and disclose all potential financial information about the company to the investors as well. Additionally, Regulation A was amended as a part of the Securities Act of 1993. The regulation permits unregistered public offerings, allowing unaccredited investors to take part. Regulation A has two tiers. Tier 1 permits unregistered public offerings up $20 million in a 12-month period, while Tier 2 has a higher cap at $50 million in the same span. Lastly, Regulation A Plus is an addition to Regulation A. It offers two tiers as well with increased caps, again granting much more flexibility to unaccredited investors. Now, let us move on to the two main types of capital firms we discussed in class: private equity firms and venture capital firms. A private equity firm invests capital into private companies in exchange for equity. Characteristics of a business that private equity firms aim to invest in are companies that are already mature, maintain a steady, consistent cash flow, and are already quite established in their respective markets. Most businesses seek assistance and funding from private equity firms when financing from a bank or another institution is not enough to fund their specific capital needs. Additionally, business owners seek private equity firms when they are in need of an exit strategy to sell their company. Private equity firms will help maximize a business market value to make the most out of the sale. A venture capital firm aims to invest in startups with high growth potential and highly creative ideas and business plans. Venture capitalists are risk takers, as most startups are known to fail quite easily. Investing in startups or considering long-term investments, as it usually requires more than a few years for a startup to reach maturity and become established in its respective industry. Lastly, let's discuss the stages in investment capital requirements. Understanding these stages can give you a potential timeline from a general idea to sale. First, we start with the seed stage. The seed stage is where a company isn't a company yet, but is merely just an idea. Entrepreneurs will need to pitch their creative ideas to investors, as like we said at the start of the video, capital is needed to run a business. At first, capital and funding comes in small amounts and is used for market research and testing purposes. Then, we arrive at the early stage, when venture capital firms love your business plan and choose to invest in your idea. The main goal at this stage is to enter the market and expand your market share. You want to be investing in advertising and product development in order for your business to find its standing and become established in the market. Finally, we get to the late stage. Your firm is in a spot where money is flowing in and out consistently. Your business place in the market is solid, reaching full maturity. You may reach a point where you reach out to private equity firms for funding specific capital needs for additional growth and expansion, or even for the eventual partial or complete sale of the business.